Hello friends, I'm Sumit. This is my YouTube channel Massive. So, so uh, 3 4 days ago, I my good friend asked me a few questions about bond yields and what is hedging. He asked me about currency carry trade. So I'm going to discuss about these things as quickly as possible without compromising the uh, quality. So let's get started. So, what is a bond? See, bond is basically a promissory note where the issuer promises to pay certain amount of money uh, to the buyer of such promissory note, that he or she is going to pay this much amount at this maturity with certain interest rate. Now I give an example. उसके बाद clear हो जाएगा. So suppose I need 100 rupees urgently. So what I'll do, I'll ask you that please give me 100 rupees. I'm going to give you this promissory note, and on this promissory note it would be written, it would be written that I'll be giving you 100 rupees back after 1 year, and also I will paying you 10% interest rate. Okay. Now, so but suppose you give me 100 rupees, okay, and I gave you bond in return, okay. So after 1 year you are going to show me that promissory note to me, saying that look, you have issued this bond to me 1 year ago. Now this is my proof, and please return my 100 rupees along with 10% interest rate. So 10% interest would be of the face value of the bond, which is in this which in this case was say 100 rupees. Now suppose you know you you suppose before the completion of 1 year you were in dire need of, it's a hypothetical example, of course. Today nowadays 100 value is 100 rupees doesn't matter much to us, okay, but it's a hypothetical example, okay. So suppose before completion of 1 year you are in dire need of needing 100 rupees. So what you will do, suppose this promissory note is tradable, okay, it can be traded with other people also. So you will go to other person and ask him that look, I need I need to sell this bond to you. You can recover 110 rupees later from Sumit, but you need to pay me amount right now. So since you are in the dire need, so it is very likely that you are not going to get 110 rupees. Okay. Well, anything can happen, but the price of the bond will not necessarily be equal to 110. So suppose you are in dire need to receive your money back before the completion of 1 year. So you are going to sell the bond to some other person, say person C. So that person C is going to give you that some amount. Okay. That can be 95, that can be 100, that can be 102. So that will be the price of the bond. Now, the interest rate was 10%. Basically, I'm telling you the difference between the interest rate and yield. Now, suppose, 1 second. So you can see, suppose the price of the, so basically, now suppose you sell that bond to some other person and you receive say 98 rupees. Okay, since you were in dire need, so you thought, okay, I'm ready to give up 12 rupees at this moment. I need my money at this point of time. Like after 4 months, you realize that you are in dire need. So you need to take money. So suppose the price of the bond is 98. So that person secures your bond after paying you 98 rupees. So to that person, see, he is going to get 110 rupees after like once the maturity comes, right? Like once the maturity is realized. So for him the interest rate will not be 10%. For him the interest rate will be, so basically 10% of 100 was 10 now. So 10 was the return, but the base, like 10 rupees of what he is gaining, 10 rupees after paying 98 only. So for him the yield would be more than 10%. So this will be the yield, right? This will be more than 10%, right? Whereas for you, had you not sold that bond to someone else, so in that case, the yield would have been same. It would have been that he would have received 10 rupees after, you would have received 10 rupees after 1 year, and for you the yield would have been equal to interest rate, which is nothing but 10 by 100. But since the person who bought that bond from you, he paid you only 98 rupees, not 100 rupees. For him, the actual effective interest rate, which is nothing but yield, for him the effective interest rate would be 10 upon 98, which will be more than 10% because the denominator is less. Now you can understand that there is a negative relationship between price of bond and interest rate. Oh, price of bond and yield. Earlier the price of the bond was 100, so the yield was 10%, interest rate was 10%. Now the price of bond decreases from 100 to 98. So the price decreases and the yield increases. So there is a negative relationship. The question, my friend asked me this question only, that Sunday, what is yield inversion? What is yield inversion? So basically, you see, now you know that yield is a function of price of the bond, but it is also a function of the tenure period of that promissory note or any instrument for that matter. So yield is also a function of, is not only a function of price of the bond, it is also a function of maturity. So I mean, you can, it's not hard to accept that the fact that suppose if I need to I need to borrow money for say 5 years. Okay, I'm not going to borrow money for just 1 year. I will be investing this money in some project which would have long gestation period. So I'm not expecting to repay this amount very soon. So suppose I would be needing this amount for a long period of time. In that case, I'll come to you and I'll say, look, give me this much of amount and I'll pay you little extra interest rate what you are getting from somewhere else, because unlike them I'm going to borrow amount from you for a long period of time. What I mean is ki longer is the maturity period, longer is the interest rate is going to be paid for that instrument, and the reason is probability of default is high. Higher the so higher would be the maturity period, higher would be the probability of default. So see, if I'm going to give you money for, there are multiple reasons in fact. So if I'm going to lend you, or you are going to lend me some amount for a longer period of time, first your opportunity cost gets increased. If you are going to lend me money for a long period of time, well, you could have lent it to someone else for a short period of time and would have received interest over it and would have reinvested that amount somewhere else. So since you are giving me money for a long period of time, first of all, your opportunity cost becomes very high. Second, it becomes high, and second is that the sooner the longer the amount I would be holding with me, there's a good chance that I would default someday, right? So of course, as the maturity goes up, normally, not exception, there are some exceptions. That's what yield inversion is all about. I'm going to come to that in few minutes to come. So longer the maturity period is, longer would be the interest rate. Okay, so in short, what I'm telling you is that your basically, so suppose on vertical axis we can take yield, and on horizontal axis we can take say maturity. Okay, so it's nothing but T0, T1, T2, basically different time periods. So as the time passes, as the maturity period goes on the right side, as the maturity period goes up, your yield would also increase, right? So basically it will be a positive sloping curve. Okay, it will be a positive sloping curve, because as the maturity period goes on the right side, your yield would also increase. So this is the normal yield curve. Okay, of course, yield is a function of it's also a function of price of the bond, but it is also a function of maturity period. Okay, so we can place both on the two dimension. Now, what is yield inversion? As the name itself suggests, that yield inversion curve will not be positively sloping, it will be negatively sloping curve. That's why it is called inversion. It is inverted. It is basically the opposite of this curve, right? It's positively sloping, it is negatively sloping. Negatively sloping means that as the maturity period goes up, your yield would start declining. So, but the question is, what is the reason? Well, the reason is that merely by looking at yield inversion curve, we can say that we can conclude that economy is witnessing recession kind of conditions. So whenever country is in normal condition, whenever country is not going through any turbulent times, we would expect a positive yield curve or normal yield curve. Whenever economy is facing headwinds, whenever there are difficult times, like right now, in fact, whole global economy is, whole global world is reeling under economic stress. Many companies are doing layoffs. So in through merely looking at yield inversion curve, merely looking at yield curve, we can say that okay, whether economy is facing recessionary conditions or not. So since it's an inversion curve, it's negatively sloping. Here it is yield, and here it is maturity. Okay, but the point is ki why? See, it's very simple. If so basically when recession will be there, it will be there for many quarters to come, not just for 3-4 months, right? It might stay there for 4 quarters, 5 quarters, depending on the number of factors, how it started, what spillover effects it may have. Okay, so during recession, it's very easy to assume that during recession there will be more demand for short term instruments and very less demand for long term instruments. Because in recession I know that I don't need money to invest in something, because I know that recession will become more worse few months down the line or few quarters down the line. So I'm not going to invest too much, considering that today I may need money. So if I foresee difficult times ahead, I'm not going to need money. So I'm not going to go for long-term instruments, or I'm not going to buy those instruments. Basically I'm not going to lend money for longer period of time. I'm ready to lend money for short period of time. I'm ready to buy instruments for short period of having short-term maturity, right? So in that way, as the maturity goes up, since there will be less demand for long-term instruments, so there will be less interest, simple demand supply game. So that's why your yield would go down as the maturity goes up. And if the yield curve is flat, horizontal, basically flat horizontal curve is intermediate condition between upward sloping and downward sloping. It's like a transitionary phase that economy initially witnessed a boom period. Now before it is going to witness a difficult time, there would come a time in between where things would be like nothing, like neither too good nor too bad. So in that transitionary phase you will see more or less, not exactly flat yield curve, but you would see more or less flat yield curve. So that would basically convey that we are more or less in a transitionary phase. So this was about yield inversion curve. Now let me talk about what is hedging and what is hedging. So hedging तो आपको इसका मतलब पता ही होगा. You know what is hedging. Hedging is nothing but covering a risk. This word can be used in any field, okay, not just in economics. So not just for financial transactions, but today I'm going to talk about hedging in financial when we engage in financial transactions. So suppose I imported something from outside and I need to pay them, say I need to pay them $1 rupees. It's a hypothetical example. Okay, suppose I need to pay them $1 rupees, and well, I told them, look, I basically whenever trade transactions take place across the countries, across the borders, sometimes exporters are also willing to give you some trade credit. Okay, look, you can pay me after 2 months also, because first of all it is going to it is going to just because just as a good gesture and to earn a good name in the market, you might allow trade credit, and there are a number of reasons for that. So basically commodities when commodities are traded across the borders, they take some time to cross the border, right? And then once they reach the ports, they have to pay custom duties, right? So so many bureaucratic like few bureaucratic hurdles may also come, right? So consider all such things, and there can be many factors which I'm not able to recall or not able to think at this moment. But consider this, that generally payment happens a little late when you engage in trade transactions across the borders. So suppose I imported something and I need to pay $1, but not now. Maybe it's say after 2 months. Now I thought कि यार ठीक है, I'll pay $1, and suppose the today's current exchange rate, I don't know what's the current exchange rate. Maybe it will be around what 75 or 80. It crossed 79 few months before. So suppose it is 80 rupees per dollar. So suppose if I pay 80 rupees, I can get $1 today only. But I thought ठीक है, I'll pay 2 months later, na, no issue. But what if 2 months later the currency, my domestic currency gets depreciated? What do I mean by that? Well, depreciates means the exchange rate gets increased. What do I mean by that? Well, suppose 2 months down the line, what if I would be paying 85 rupees to sit, although this is very unlikely, but generally such big change doesn't happen, but even a change of 1 rupees would mean a lot if you have to pay a bigger amount in dollar. So suppose the value, suppose the exchange rate gets increased, or domestic currency gets appreciated, say after 2 months. So in that case, I will be paying 85 rupees from my pocket to buy $1, and then I will be using that dollar to pay the exporter. So in that case, basically, I incurred a I incurred a loss, right? Because why? Because foreign exchange, there was a because we witnessed volatility in foreign exchange, and volatility do happen. Volatility do happen in foreign exchange market. So and we call this open position. So whenever we are facing foreign exchange risk, we can say that we are facing open position. To cover open position, to cover foreign exchange risk, we engage in hedging, and hedging happens in number of ways. For hedging, you can either buy options. For hedging, you can either participate in forward market, or for hedging, you can even take amount. You can borrow amount today. Okay, it can happen number of ways. So this is what's the hedging. If you're still not clear, you can comment. You can drop your comment. I can explain you through good examples. But I need to make this video as short as possible, because I'll be sharing this video with one UPSC aspirant. ये वीडियो उसके लिए लंबी हो जाएगी. So he just asked कि hedging का आइडिया बता दो. hedging का मैं एग्जांपल भी दे सकता हूँ कि फॉरवर्ड और ऑप्शंस के थ्रू उसको कैसे किया जाता है. पुट ऑप्शन, कॉल ऑप्शन क्या होता है, मैं उसके ऊपर भी कॉल ऑप्शन, पुट ऑप्शन का चलो मैं एग्जांपल आपको दे देता हूँ अगर आप इतने वो कर रहे हो तो. So suppose, what is call option? Okay, listen. Suppose take this example only, that I need to pay you $1, okay, after 2 months. Now suppose, so basically what happens in forward market, that if you buy some, so basically I can ask you to have an agreement with me, where I'll tell you that, look, after 2 months, boss, after 2 months, I will be paying you, I will be paying you 81 rupees to buy $1. Suppose I had one agreement with some other person, not the exporter. I'm just telling you that, okay, I'll be paying you 81 rupees, but I need $1 after 2 months. No matter what would be the exchange rate at that time, no matter what would be the prevailing exchange rate at that time. This happens in forward market. You basically engage in agreement where you predetermine the rate of exchange of the transaction you are talking about, and you also decide on the particular date on which it would take place. So you decide the date on which the transaction is going to take place, and you also predetermine the rate at which it is going to take place. Why it happens? It happens to basically to cover your open position. Okay, that is one way. Or you can do also one thing. You say कि ठीक है, I asked him कि ठीक है 80, suppose 80, I'll pay you 81 rupees and you give me $1 after 2 months. Apart from that, you also buy the options. What is option? Option gives you the right but not the obligation to buy or sell. Not clear? No problem. I'll give you an example. So suppose I bought, basically call option is something which gives you the right to buy something which you have decided in agreement, but not obligation. So it's your discretion. You have the right. If you exercise your option, call option I'm talking about. If you exercise your call option, then you have the right. The seller cannot refuse to you to not sell that whatever that instrument, say call option, right? But if the conditions are not allowing you, then in that case you may not exercise that option. So it's not an obligation. It's not mandatory for you to exercise that option at any cost. Similarly, put option is where you have the right to sell some instrument but not the obligation. You don't have the obligation to sell it. I bought a call option and I said कि ठीक है, and the call option we decided that I will be having this option that after 2 months I can pay you 81 rupees to secure $1, and you cannot deny that, because the call option definition is that I have the right but not the obligation. It means that they suppose us in future, say after 2 months, the exchange rate becomes 78 rupees per dollar. In that case, I will not exercise my option. I will not be paying you 81 rupees for $1 because I can buy $1 in the market by paying 78 rupees. I am saving 3 rupees. So in that case, I will not be exercising my call option. Although there is also a condition. If the commission is, so basically I did not save 3 rupees. I will not be saving 3 rupees exactly. I'll be saving 3 rupees minus the commission I had to pay, irrespective whether I would be exercising that option or not. In a similar way, you can think of put option, which is the option which is the kind of option where you have the right but not the obligation to sell some instrument, which is option in this case. Okay, so this is again kind of hedging only, right? So hedging happens in number of ways. Okay, now let me talk about currency carry trade, the last topic for today. So in currency carry trade, what happens that investors all around the world, they look for returns in currency market. As the name itself suggests, currency carry trade means basically carry of an asset means the return of an asset. So currency carry trade means when investors look where we can get the highest returns in currency market. So what do I mean by that? So suppose in India interest rate is 4%, hypothetical example. In US the interest rate is say 6%. So investors would notice कि look, there we can buy securities and can get relatively high return over security and can reconvert that dollar into rupees and can sit back at our home and have pizza with Pepsi. I mean, in India interest rate was 4%, there it was 6%. Why not we invest there? But of course, it's not that easy. It's a little complicated also, because once they will be reconverting their dollar into rupee, what if they incur a foreign exchange risk? What if the Indian currency witnesses appreciation? In that case, they will not be getting enough rupees, and so they won't be having a pizza, right, at home, sitting back at home. So of course, but yeah, currency carry trade, it is basically, it happens when investors all around the world, they basically look for high yielding currencies and invest in such currencies, in such currency markets. So suppose I don't have money. Okay, what I will do, I know that in India interest rate is say 4%, but I don't have money. What I'll do, I'd borrow. I borrow 100 rupees from my friend. I say, ठीक है, don't worry, I'll give you after 1 year, I'll give you this much amount along with interest rate. What I'll do, I said, ठीक है, I have 100 rupees. I go to the foreign exchange market, I convert into dollar, I buy the US security, I earn a higher interest rate there, and so after that, after maturity, I'll be reconverting that amount from that market back into the rupee, and would earn a decent return over it. And since I won't be paying much interest rate to the person from whom I have borrowed the amount, because in India interest rate is only 4%, so I won't be giving him higher than 4%. In fact, I may be giving him I won't be giving him too much above the 4%, right? So, and since here the difference is 2%, which is quite good, which is quite much, which is quite okay, quite a lot. Don't consider that I'm only going to invest 100 rupees. I just took a hypothetical example. 2% multiplied the amount you have invested. That amount, magnitude of such amount can be high, right? So in that way, that 2% is a very big difference. So even if I pay interest to the person from whom I borrowed the amount, even in that case, even after considering that, I can gain a lot from investing in high yielding currencies. So this is what currency carry trade is all about. That you basically borrow in low yielding currency, convert that into high yielding currency, invest in that country's securities, earn a higher rate of interest from there, and can reconvert that. You will be reconverting that amount back to domestic currency, and then you can have pizza and Pepsi sitting back at your home. But as I told you that it can be complicated, because once you will be reconverting that, you may also incur high foreign exchange risk, for which we can engage in hedging, we can engage in options, whatnot, which I already discussed few minutes ago. So this was it. कोशिश तो यही थी कि I will be very brief, but I couldn't, I can't compromise the quality of the content. So thank you so much for your time. If you have any doubts, please drop your comments. Take care. Have a good day. Keep growing.